The Fed will be holding fire in September. From a data perspective, in the last couple of weeks, we've seen weaker employment data. We've seen CPI numbers pull off. We've seen PPI numbers come in much lower than expected. Retail sales and consumer sentiment has all dented the dollar. We have seen a fairly sharp turnaround in how things are looking for the US economy. The issue we've got, of course, is geopolitics. That side of things kind of gives the inflation side of the equation for the Fed a little bit of pause for thought. Hello and welcome to ATFX's US data and Fed update. A recap of what we've seen over the last couple of weeks, and there have been some big moves in Fed rate expectations as well, how they're affecting markets, and a few trade opportunities as well. So we'll cover gold as we always do. We'll have a look at euro and we'll have a look at dollar yen as well. So first up, let's have a look at the data that we've got through the month of August and how it's changed our expectations for the Federal Reserve. As we went into the month, inflation concerns were still high. We still had high inflation, sticky inflation numbers out the US, and a continued war in the Gulf that's raising concerns and is at the moment as well. But from a data perspective, we have seen a fairly sharp turnaround in how things are looking for the US economy. So first up, the big one that we got, as always, on the first Friday of the month, non-farm payrolls. They came in much lower than expected. They were expected to be around plus 80,000. They came in minus 23. So big shock to the market, big shock to the dollar. Dollar took a big hit across a range of products. But it didn't stop there. So that's part one of the Fed's dual mandate. That's the employment side of things. The week after, last week, we then got inflation numbers. So we got the key CPI data and we got the key PPI data as well. In addition to that, we also got a little bit of retail sales update and consumer sentiment. So CPI first up did come in kind of on levels of expectations, but it was lower than we'd seen before. So cooling in inflation, not down to the levels that we wanted to see or the Fed would like to be seeing, but certainly sort of a pullback. But it was the PPI number that really started things rolling. That came in much lower than expected as well. That came out on the Thursday. So really, we started to see Fed rate hike expectations pull back, and they've pulled back. So a month ago, we're about 50, just over 50% expecting a 25 basis rate hike. We're now down to about 35. So looking around about 65% chance that we will see, and it will be a live meeting in September, 65% chance that we see rates stay on hold. In addition to that PPI number coming in weaker, on Friday we saw retail sales coming much weaker than expected. So certainly the US consumer pulling back on its spending. Also, the University of Michigan consumer sentiment data came in a lot lower than expected as well. So all these numbers, it did build up from a data perspective that we really think the Fed may well be holding fire in September. The issue we've got, of course, is geopolitics. Overnight, we've heard that Iran and the end of the ceasefire has come into play today, or yesterday actually. So we have got Iran saying that they will become much more aggressive with military action in the Strait of Hormuz. We have got the US saying they will ramp up the game. President Trump saying no when asked if the ceasefire would be extended. He's also threatened to bomb Oman if they stand in the way of US actions in the Gulf. So that side of things kind of gives the inflation side of the equation for the Fed a little bit of pause for thought, because we could see next month's data jump back up again. So interesting times, but from a data perspective, and don't forget, central banks generally do want to work off of a data perspective rather than guesses. Things are looking aren't looking as great, I suppose, for the US economy. Even though I must say stocks are still trading very close to all-time highs. The dollar's certainly pulled back. The dollar-US yield relationship's been a bit mixed as well. Yields have started to push higher on the geopolitical concerns, whereas the dollar's come off on the back of the data factor. So lots going on, but let's have a quick look at where there's some trading opportunities that could come up. So here we are with the familiar daily gold chart, if you've been tuning into our videos. And if you haven't, please subscribe and we'll keep you up to date with as much as we can as it flies around in the markets at the moment. This is the gold move that we've seen recently. So we did break out of this range, really strong breakup when we had an over 4% move right at the start of August. That kind of coincided. It was the day before, I think, the non-farm payrolls, but certainly preempted that. Yeah, there's the non-farm payroll day. We have seen gold continue to move higher. The correlation that we've seen over the last few months has been strongly with the dollar side and the yield side of things for gold, but we have seen gold react to geopolitical uncertainty recently and has touched up to new highs. So it is interesting now. We are trading just below recent highs, just underneath 44.50. The trend line is coming in around about that level as well, and 200-day moving average is not too far away. So recent three technical levels: recent high, strong trend line resistance, and the 200-day moving average. If we see the dollar starting to get hit, and that could be on the back of the data that we've seen, it could be on the back of geopolitical concerns receding, we could see a great break trade through this high, through that trend line and above the 200-day moving average. Opening the way, I would say first stop is probably around these highs here, 47.75-ish, and then it opens the way for bigger moves up towards these recent highs. So gold, potentially great moves. Of course, if we do see, probably it's going to come from the geopolitical side of things, the dollar starting to push higher, we could see gold drop back into this range. But as I said, a bit of a tricky one at the moment. Gold is been following the US dollar for the last several months, really. But geopolitical concerns are starting to dictate. We're starting to see it bought on that. So great trading opportunities there. Big, strong resistance line. So moving over now to FX, we'll start off with Euro. And here's the Euro daily chart. Similar situation there. We popped up to multi-month highs yesterday, up to 116.14. It has come back down underneath 116 figure. But again, we've got that high and trend line support. Really, it's the high we're looking at. But the 200-day moving average coming in just above it as well. So similar case, if that data really starts to pressure the dollar, we could see break trades to the top side. Again, if inflationary concerns from geopolitical, if the war does kick off again in the Gulf, we could see some dollar buying. That'd take Euro back into these familiar ranges that we've got there. So good trading opportunities. Most people will be looking to have some sort of a position on in Euro and in gold indeed. We'll just go and finish this off having a look at the ever quiet dollar yen. And so here's that daily dollar yen chart. It is messy, let's be honest. It's a bit of a painful one. Various series of intervention. You can see them along here as I'm moving with the cursor. This is the big one that we saw right at the end of July. It took us down 4 or 5%. We have rallied since then back up to just underneath 160, the figure, whether they're around there or not. Looking at the other currencies, possibly not. We've just hit a bit of a break in the time, but fundamentals probably still pushing for further moves back to the north of this. Dollar yen could be a very interesting trade. Expect high volatility. If we do start to push higher, that could come with the war starting again in earnest in the Middle East. Keep an eye on that US-Iran situation. Keep an eye on the Saudi Houthi situation. If dollar starts moving up, you could see the Bank of Japan and maybe the Fed again coming in and smacking markets. If we do see US data start to lean on it, we haven't really seen it lean too much on dollar yen. And I would suggest that's because it was kind of out of kilter due to the intervention. We could see dollar yen move back here. Initial support now, 200-day moving average, 158.28, I think. And then trend line support now coming in just above 155.50. And really that low down there at 155.21. So interesting times, expecting plenty of volatility in the next few days. That data really is leaning on the dollar at the moment. But if it combines with a geopolitical fix and we really see a pullback on Fed rate hike expectations, we could start to see the dollar come off a lot harder. Thanks for tuning in and good luck with your trading. Cheers.